The first, do we have any public comments? No. The first item on the agenda is the approval of the minutes of the meeting of April 26, 2010. Second?
Second. Sorry.
Any objections? Minutes are approved. The next item on the agenda is the Audit Committee work plan. I guess that the question here has to do with the delivery of the first quarter financial statements, and is David Jones here? What is it, 53? Gansby 53.
53? 83?
What's the number of the Gansby opinion? So I understand that we're delayed in terms of our first quarter financial statements because of the decisions to be made concerning how we present our statements in the context of the Gansby 53. When did that principle get first published? When?
It's about 2 years ago.
And it's been clear since then that that applied to us for the year beginning January 1st?
Yes, sir.
So why is it that here we are halfway through June?
About 2 years ago, the issue was discussed with management, and there was a decision that was made relative to the application of GASB 53. And given current circumstances, there was a decision made by management to challenge whether or not that accounting was appropriate for today. They're re-challenging the accounting, looking at it. They may make a decision to change what had been what they may decide to change the direction relative to the application of the accounting standard. That's purely a management decision.
Yes,
it's not a Deloitte decision.
Yes, it may be an accounting, a management decision, but it would seem to me that the timing of the consideration of this matter might actually rest with you as our as a practical matter, sort of accounting practice consultant as well as our auditor.
No, sir. 2 years ago, we did consult with management.
I would suggest that 2 years ago was really not the relevant consideration, and that the relevant consideration was probably the first 3 months of this
Mark,
year.
I beg to differ, and we can, but there was a decision, and there was a logical process relative to looking at the application of the accounting standard. Management made a decision. By the way, it's their decision. It's not a Deloitte decision. Management made the decision, and we concurred with it.
The question that I'm concerned about at this moment is that it's the middle of June, and we don't have the first quarter financial statements because of this topic. I'm not concerned about the substance of how we are choosing to comply with the principle. I am concerned about the timeliness of our financial statements, and as our auditor, I put a large portion of the blame for that particular problem, should there be any blame involved, on yourselves as a practical matter.
I'll take the blame, but to be honest with you, I mean, it's really not due. I mean, because
perhaps then, if we should end the topic with the fact that you accept whatever blame might be due,
blame you want to give me.
I would sort of suggest, I understand, I don't think that it's of enormous importance, frankly, that we are obliged to delay the financial statements, but I would hope it's something that we can avoid doing.
I would do that
as we go forward.
And by the way, Mark, I concur. I totally concur about the timing of the financial statements. Agree that they should be timely. It has been a goal of mine, certainly since I've been involved with the account, to have timely financial reporting, and would encourage it. That is truly a goal, and I think this is a first. I'd ask for management's view.
I think, talking with staff, I think one of the questions that I at least was a little surprised was that this was not something that we could do for the second quarter. That it was an analysis that we were going to do, we became aware of it, and we could have it done for the second quarter. David pointed out when we met a week ago, I guess, that no, it has to begin at the first quarter of the financial statements for which they rely.
For which the standard was implemented.
And the standard is for any financial statements after June 2009. Apparently, because we do quarterly statements, it applies to each quarter.
Yeah.
And so that is an issue.
I think I understand the issue, and I'm not, my concern, again, is not really with the, I think it's unfortunate that the first quarter financial statements are somewhat delayed. I think that the substance of the issue is obviously something we're obliged to address, and I believe that we basically have at this point. However, the fact that you as management understood the application of this principle as you just described a week or so ago
Yes.
has driven my earlier comments with respect to Deloitte's performance here. And I think we should move off that particular timing question. Is there anything else that needs to be discussed with respect to the work plan?
Are we going to discuss this issue more, the GASB 53 issue more over the course of this meeting, or is that it? Because I have a question and I could get it in now or wait.
Should we raise it now? We should raise
Do it now? Okay. And Michael, you and I had a kind of private conversation, but maybe it would be good to just publicly state, when I look at these financial statements that are marked draft so big that I can't read them, but that's another issue. The swaps are discussed on page 75 through 88. What is going to be different the next time I look at this?
The answer is we don't hardly know, right?
We are putting, let me just go through a little bit of the process. We asked the Swap International financials to put together their version of what they perceive as the ability to do the proper and effective hedges. If that is the case, these would be balance sheet entries where you have essentially unrealized gain or loss, plus the full boat of the all of the 16 or so hedges on the balance sheet. So it would be an asset and a liability. If going forward these things turn sour or there's a problem with them, then they become income statement issues. We will look at that every quarter and go through that determination.
But I guess now sour, they go sour, right?
Meaning that they become ineffective. They don't
Okay.
follow the ability to hedge the risk.
Okay,
of
so the
debt.
fact that they are underwater does not make them sour.
No.
Not necessarily.
No.
Okay, but two of them qualify, we think.
We think right now that they don't qualify as an effective hedge, but
And-
we're still going through the process, and we still got to do fuel hedges.
What would make them not qualify? What makes those two different from the other 14?
A mismatch in cash flows. I mean, because that's one of the
Okay.
keys, that you have to have the cash flow. And as you know, on our two Broadway swaps,
They become
they're-
investment.
That's
I'm
right.
sorry.
They're very,
I'm
the
sorry.
cash flows that we're receiving and the cash flows that we're paying are not the same.
Okay.
And so that's really one of the key. There's a number of tests, but one of them is that if you have kind of a mismatch in cash flows, and it doesn't have to be perfect, but you run your analyses and it's very close to being right there, and that's one.
But on the 14 that are still considered to be effective, are we going to be able to pick up this document on a quarterly basis and somewhere see what the fair market valuation of those
Yes,
are?
we will put it as part of the
In-
part of that note in addition to. Absolutely.
Okay. Thank you.
I mean, the issue is that, Doreen, once they are designated for hedge accounting, you know, they have to basically maintain effectiveness. Now, if they fall out one quarter, then it's no longer a hedge, and can never be a hedge ever again, because then you recognize the gain or loss in the financial statements, and you move forward using mark-to-market accounting. So any changes would flow through the operating statement. On a cash basis, it's neutral. It has no impact on cash whatsoever.
Correct. To go back to something that Mark said, and I don't want to revisit the history of the last 3 minutes, but was this discussed with you by the prior CFO, GASB 53? Was it discussed with you
Yes.
last year? And the
Yes.
decision was made
To not use hedge accounting, to use market accounting.
And what was the reason for that?
At that point in time, actually, there was a little testing done at that point in time to determine effectiveness, and the question was whether or not the securities, it was uncertain at that point in time as to whether or not the securities could continue to maintain hedge accounting over the life of the instruments. And because
Is
of
that because of the market disarray?
Yeah, it was a lot of things at the point in time, right? But and as a result, the decision was made because it was a non-cash item, just to use mark-to-market accounting. Because if you took a loss, it recovered over the life. So you take a loss, and it basically bleeds back to neutral.
Yeah,
that was the decision.
Okay. Well,
But that was discussed with the CFO, and a decision was made.
Very happy that we have Bob, who has an accounting background, so he can speak your language in a way that I think our prior CFOs have not. So I'm very grateful for that.
I will say, once we get the determination of what those particular hedges, if they're effective or not, we still have to go through a process where it's reviewed by Deloitte to make sure that the tests are all complete and okay.
Very interested to see that. Will you be talking to us more about that as
Yes,
you reach those
absolutely.
determinations?
Yeah.
Great, you.
We will actually perform an audit. Normally we do review procedures for the quarters, but as this is done, we'll actually audit it because it's such a material part of the financial statements, and getting it right the first time is important.
This issue of a derivative once being determined not to function as a hedge can't thereafter be determined to function as a hedge. My understanding is that one of the issues here has to do with the current marketability of the obligation whose debt service payments are supposed to be matched by our side of a swap contract, and that we have a certain amount of auction rate debt that is currently being carried at its default interest rate. And to the extent we have swap contracts relating to that debt, because the debt's not
A perfect cash man.
isn't trading on its normal basis, it's not a hedge, whereas, as I understood it, there was a possibility of moving the allocation of that swap contract to other variable rate debt that is successfully trading, and having the swap then be considered a hedge and having it come off the
You can do that. You can designate any instrument as a hedge for another, but you can't swap back and forth. Once you've the issue is, Mark, once you've designated an instrument and designated a hedge, once it falls out, then there is a presumption that, and it could come back in, but once it falls out, the presumption under the accounting rules, and it's a very big SEC issue, by the way. But once that happens, then there's a presumption that it can no longer effectively maintain itself as a hedge over the life. That's an accounting decision that's just been made. So it's once you sin, your sin stays. Even if you repent, your sin stays with you forever.
Wait a minute. You've said that, and you've also said, however, that you can allocate it to different debt and have it straightened out
At the beginning.
At the beginning, you mean, I'm sorry, we'd like clarification. You mean at this time
At
right
this
now?
time, by the way, it's as if you have, Mark, the issue is because now you are adopting this accounting today, So you get a free start. Whatever you did in the past, so you can take instruments and designate them, but particular assets for particular swaps to particular liabilities. Now you have the ability to do that. Yeah, at the beginning. But now from now on, once you enter into a contract that has, that the two instruments are designated as are tied together in a hedging activity, you're stuck forever. But because of the implementation of the standard, you have a one-shot ability to designate instruments at that time that you adopt the standard.
I guess that I see this hedge logic as making sense for us because, as I understand it, it recognizes our kind of the substance of our economic position. We undertook to pay one side of a swap contract in order to avoid the variability, I guess in at least the case we're talking about, of our debt obligation because the other side of the swap contract was going to cover the debt obligation. And that's the deal we made. That's the deal that we're still under. And to recognize variations in the market value of that swap from time to time as affecting the financial picture presented in our statements doesn't seem particularly relevant. So I think that our proposal here actually makes sense. Obviously, if the derivative contract, if the swap contract, if the link between the payment to us on the swap contract and our debt and the debt obligation with which it's associated breaks, then yeah, you have the debt on one side and you have the swap contract on the other, and the fact that you have to report the value of the swap contract.
It's actually the change in the market value of it, which is difficult enough itself.
And as I understand it, the swap advisory contract that was approved in committee earlier today is actually one of the pieces of enabling us to do this.
Actually, in other processes, you do have to have a process to monitor it in order to
all these transactions short-term?
No, they can be, generally they're as long-term as the debt that they were associated with.
30 years in most cases, 25, 30 years.
You know, not to, I'm sure someone's going to jump down my throat for saying this, but these are hedges with a nudge and a wink, because when we entered into these swaps, it wasn't because, we have variable rate debt and we want to create an upper boundary to our risk. It's because the cost of synthetic fixed debt was less than conventional fixed debt. That's why we did it. It wasn't really about hedging. It was about getting what we thought was the lowest rate of interest at the time.
And that was part of the decision because it was non-cash and really didn't impact. I mean, the economics of that portion of the transaction was the economics. And that was the purpose. But nonetheless, you have the ability to look at it. The decision's been made to look at it, and I concur with it.
Yes. I guess the one thing I would like to add on the score on this score is that because of this outstanding issue, we don't have financial statements ready for this meeting, but I would very strongly hope that we wouldn't slide beyond the next one.
I don't think so.
We will not.
Good. Anything else on the work plan? Thank you. The investment compliance report, which I think is...
That is me?
Yes.
within your package, there is a one-page report, thanks, that basically does this. As your auditors, the state of New York requires us to provide them with a report, i.e. it's a negative assurance report on your compliance with the investment guidelines that are prescribed by the state and the state controller's guidelines. As part of our audit, we do perform procedures to evaluate the entity's compliance with the state of New York guidelines. As a result of those tests, having performed those tests, we found nothing that would cause us to believe that the organization wasn't in compliance with the New York State guidelines. In addition, in your package that was previously sent to you is a report that's referred to as the Independence Accountant's Report on applying agreed-upon procedures. As is past experience, you have asked us to, versus perform an audit of the Inspector General's, you've asked us to perform a number of procedures relative to their financial activities over there, and we have done those. I wish to point out on page 2 of those reports that there were 2 minor exceptions. One relates to the fact that the bank reconciliation for the month of December's IG's general fund did not agree to the authority's general ledger. That is one of the requirements you've asked to perform, and it doesn't agree. Doesn't mean a lot, but it doesn't agree, and it's not by a lot, but it didn't. In addition, you've asked us to read and determine if the IG's monthly expense report reconciles to the expense report to the codes listed in the MTA's general ledger and reports. We found that for the month of December, the IG's monthly expense report, or the MTA's report of IG expenses was $56,000 less than the IG's report, and that has been an exception in the past as well. It's not a material issue. Nonetheless, it is an exception.
Can you give me what the 56,000 is a variance on? What was the size of the base that you're looking at?
Jill, do you remember? By the way, it's listed in the report, but it doesn't list them. Do you remember the amounts? What made up the 56,000?
No, I'm looking for the base that 56,000 was a variance on.
There were like 5 accounts. There was the majority of it had to do with success.
Mark, there was they had some capital purchases that didn't meet.
You're not getting me. The total category that failed to match.
Their expenses were $56,000. The MTA's expenses were $56,000 greater than the IG's, and most of that related to it.
You're still not answering my question. What was that? Can you give me the total expenses that you're looking at here that came up with the 56 difference?
Oh, okay. 278,000, I think is right.
No, it's quite larger than that.
Oh, really?
Yeah. I would say it's closer to
I'm sorry.
750,000 approximately.
Mm-hmm.
Something like that, maybe 800,000 for the month of
December.
And is that a difference that comes up in that month? Is that a cumulative difference that relates to the all 12 months?
It's predominantly, it's basically related to one item. While there were 5 smaller ones, it's related to one item. There was one item that didn't qualify for it did not meet the capitalization policy of the MTA as a capital item, and therefore it was expensed, and it was capitalized with the IG's office. So that's the majority of the difference.
Difference in methodology.
It's a difference in methodology.
It wasn't a mechanical error, it was a difference in
Methodology,
How it's
correct.
utilized, okay. One was capitalized, one.
One was expensed.
All right. That's just a question of.
So has that been corrected?
It won't ever be because of the differences.
Okay. The, the item that you were talking about the IG General Fund's bank reconciliation for '09,
Yes, sir. Number 7.
does that relate to this 12, or is that a wholly different thing?
A wholly separate thing.
And order of magnitude?
$5,000. $5,078.
All right.
But now I have to point out, by the way, upon agreed upon procedures, an exception is an exception and has to be reported to you, whether,
Yes, but if you gave us a sense of the order of magnitude as you were reporting it, it would probably be informative.
So we'll get to that in the next round of the letters, so.
Yep. We need to, as I understand it, officially accept the report. Second? Any objection? Good. The next item is the management letters.
Mr. Chairman, may I ask that we move the management letter to the end and deal with the single audit beforehand? The reason being it's a relatively quick item,
What is the single audit?
the single audit.
Okay.
In your package, you have it's what's referred to as a single audit, but it is our audit of the MTA's federal financial assistance programs. As your auditor, we are required to perform an audit of that in accordance with the government auditing standards, and we have done that, and have issued our report on the schedule of federal assistance that appears on pages 1 and 2 of the package that you have. And basically it says that the schedule of federal assistance is fairly presented in relation to the basic financial statements. On pages 108, we have issued an audit that's performed in accordance with government auditing standards requires us to report on the internal controls over federal financial assistance programs, and it requires us to issue a report on it. We have done that, and it also requires us to issue a report on the compliance with the requirements of each of the major federal programs in accordance with OMB Circular A133. On page 108, we had 2 exceptions. One related to the maintenance of certain records required by the federal government that weren't, and resulted in some question cost that was immaterial to the total. In the second report on internal control, because you had an item that resulted in question cost that wasn't material to the individual grant program, but nonetheless resulted in material cost, by definition, it is considered to be a significant deficiency and has been reported as that.
How much is it, again, can you give us an order of magnitude of the problem?
There is a schedule. I was looking for that. I was anticipating your question. Yeah, $14,000.
And can you give us a sense of the size of the universe the 14,000 is a part of?
Which program was that? Let me look.
Well, total expenditures are $2 billion.
Yeah, but it's the total federal expenditures are $2 billion, but millions. You know, it's in the individual program.
And I think you said that this was a significant.
By definition, I said by
by
definition it is a significant.
What is the definition we're talking about here?
The federal IGs believe to the extent that you have an item that results in question cost, no matter what size, because it has the potential to result in additional question cost, it by definition is a significant deficiency.
That doesn't sound like English to me. I have difficulty with your translation.
Would you try explaining
You're
that
saying
again?
if it was a dollar change in the thing.
Let me explain the federal rules.
Doesn't make any sense to me at all.
Well, because we did a test, by the way. Now, this is not an extrapolation of the dollars. So the $14,000 was based upon the individual items that we found that were deficient, not the entire grant, but just $14,000 of items. And it's not extrapolated to a total population, so we looked at 10 items and 4 of them I think were bad. So it's not an extrapolation, but you know, because it was it resulted in an amount of question cost under the rules.
An amount of question cost, meaning we said we spent the money, we collected the aid for it, and you found that we had not spent the money?
No,
Is that
the
what you
issue is you
said?
hadn't documented it in accordance with their standards. We
We
could
said
find
we
that you
spent the money, but you couldn't find the documentation for the spending for
Not
that
all of their
$14,000?
specific documentation for $14,000.
Uh-huh. Okay. And the import of this significant difference?
Is that the the agency should, you know, obviously, in order to demonstrate its compliance with federal grants, should maintain all the required documentation. That's the importance.
Do we have anything to say on that?
We have contacted the agency. We have indicated that they have to provide the proper documentation and to look at what their internal controls is on that matter. I don't have an answer back yet at this point, but we will have probably by the second quarter, and I could get back to you on it. I think it was the TA, wasn't it? I think it was the TA.
Is there a consequence to this?
They may ask you to pay back $14,000.
Okay, fine.
They may. Not certain. They may. And in the past, they haven't.
Good. Thank you. Do we need to act on that? Do we vote to accept your single audit? Is that the?
Yes, sir. Yes, sir.
So could I have a motion doing that? Second? Any objection? Good, thank you. Management letters?
As your external auditor, we have performed an audit of each of the components of the MTA for the year ended December 31, 2009. Issued our reports. We have issued you a management. By the way, we have issued you a management letter which doesn't constitute a report on internal control. As your external auditors, we would be required to report to you anything that we would find that would be considered to be a significant deficiency or a material weakness in internal accounting controls. We have none of those to report to you. There are a few items in the management letter that relates, and by the way, the letter separates out, the letter is separated by each of the components with individual items relating to each of those components. The items in the letter constitute some improvements for recording of transactions. Most of the items in the letter deal with IT security as it relates to either password security or data security. There's nothing that's real material. The things that we see are common. One thing I would point out that we see at a lot of places, and it's not unique to you, but the types of items continue from time to time to time. It might be worthy of the MTA to kind of look at those categories and see if there's any particular fix that could help alleviate those problems. We also have two comments in the headquarters management letter that relates to the capital loans that we'd previously discussed with you. And we think our recommendation is there that that management needs to put together a plan to basically determine the potential repayment of that loan and basically, discuss it with the board. That's our comments. I'd be glad to answer any questions.
Yeah, I looked at it and saw there's 17 pages of comments. As you say, some of the comments are relative to security, some of the comments go to the controller's office or the controller's structure. Nowhere in looking at the 17 pages can I judge whether or not they're significant or they're not significant, because I don't have a picture of what those discrepancies were relative to the total picture of the event at that point in time. So rather than jump on the fact that 17 pages strikes me as a lot, and that there are at least a half a dozen controllers' items in there, I would open it up to have a response as to why we have so many discrepancies.
Well, in terms of MTA headquarters, there were a total of 8 management comments for 2009 and 2 from 2008 and 9. For our auditing issues related to the controls group, for us, comments 1, 2, 4, and 5 dealt with reclassification of current to non-current investments.
Why is it difficult to tell short and long term? I mean, that's apparently at least several of the comments were related to that.
Well, essentially, it has to do with communications from the Treasury Department in terms of how essentially the items have to be booked. We have put together a process where we will have determinations from bond counsel as well as from the Treasury before we put any entries together on those. In fact, they have been taken care of already. There are no issues going into the second quarter related to those types of problems. I will say that we are working with a short bench. I know that's not an excuse, but for the last 3 years we've been cutting head count. We had 2 big illnesses in our area which basically take care of this type of stuff. With that, everybody's back to speed at this point, and we don't anticipate having any more problems going forward. But I assure you that if it didn't hit the year end, it would have been cleaned up in the post-close of the first quarter, which has occurred. And I think Deloitte & Touche could basically speak to that. In terms of the $500 million loan, we are putting together a plan. We will discuss it with Deloitte & Touche along with the new CFO to start the repayment process on those both issues. With that, that would be the only hanging issue out there that we have to basically take care of in 2010.
Do you believe that you're okay staff-wise at this moment?
I never do.
Well, that's an unfair question on my part.
There's three or four issues. We're transferring people to the BSC. We're in the process of workforce reduction. We have voluntary retirements, and I deal with a very old staff. They've been there 20, 30 years. Things are basically, being situated at that way. We feel that with our reorganization that I talked to Bob Foran on, that we'll be able to cover all the bases going forward, in addition to taking on any additional accounting pieces that we have to look at in the future, which they'll be coming down the pike.
In transferring people to BSC, are the responsibilities traveling with the people, or are
Yes.
you going to?
Yes.
So you will not have remaining responsibilities without staff to do
We
them?
will be out of the production industry of accounts payable and payroll, as well as bank recs and other items that are going over there. It will be strictly a corporate office type of operation going forward.
Something struck me on the first note in here, and that is that we've spent how much money? $75 million, $100 million on this PeopleSoft system over time?
Yeah.
And it cannot adjust at interest rate?
There's a piece in there that's called Deal Maker, and it's one of their particular modules. We have to deal with the fact of providing templates from the Treasury Department on how they book it in the Treasury area, going then being you shake hands, it goes to the general ledger. That has the particular problems that we're talking about from the reclasses. Again, before we even set those templates ready to go, we are now sitting down, bond counsel, the finance area, and the Treasury, anytime we open a bank account, anytime we do any of these investments, and we'll get it right from the start.
But you're talking about the investment issue, but I think that Doreen
Debt-
was
the-
concerned about
the debt issue here.
having a fixed rate bond that actually has a change in rate at a given moment before its maturity, and the fact that the system couldn't accommodate that.
We have been basically doing that type of transaction through the years. It's felt now that the better way to do it, which was essentially determined by Deloitte and Touche, is to go that route, and we certainly agree with that.
I'm not sure.
Go that route?
It's a change in accounting of how we basically view that particular item.
No, I don't think you're understanding me. In this book,
Yep.
number 1.
$71,750,000.
No.
I don't
No,
have-
page 6.
I don't have the book.
Oh, you don't
I'm
have
sorry.
the 6.
I don't get
Okay.
a book either.
No, my comment was just that we've spent a tremendous amount of money for this PeopleSoft system, and if they can't do something as simple as allow us to adjust an interest rate,
Oh, I see.
it makes me frightened to think of what other inadequacies
Yeah,
we're
it's-
going to encounter
it's
with
not
this
done.
$75 million system.
It's not done easily, but it can be done, and we're working on it with the programmers at this point.
Okay.
I'm sorry, I misunderstood your
That's
question.
okay. I know you did. Okay.
The, I guess that maybe the point's already been made, but, you know, the kinds of questions that I was asking about the size of the base, I mean, the thing about the management comments and the discrepancies listed, this $500 million loan from capital financing, I think it's pretty clear the sort of size of that issue. And I know it's been discussed, I don't know whether it was in this committee or with another committee or the full board, but it's been around for several months as a substantive issue that we need to deal with. But the other discrepancies are difficult in reading the management letter for purposes of what to worry about and not what to worry about. I understand their discrepancies, but if it were possible to put in some sense of the relative weight of the different comments.
I mean, that's a fair comment.
That would be hugely
That's a fair
helpful.
comment. Most of these are compliance issues.
No, we understand, but
No,
reading it as an outsider.
It sounds scarier than maybe.
I agree with you. They're not, by the way, you know, accountants, and I'll apologize, accountants designate these things as significant deficiencies and material weaknesses. And we, by definition, would say you understand that. So those things are things you really worry about. If you know, we call them those, then there's things to worry about with the exception of the federal stuff, so, where there's rules around what applies. But in a management letter, if we'd called it a significant deficiency, which, by the way, by definition means, let me go with a material weakness first. A material weakness is defined as an item that, if it remained uncorrected, could result in a material misstatement of the financial statements. So if we found an item like that, we're required to report it to you and to call it that. A significant deficiency, by the way, a material weakness is a significant deficiency, but there could be other items that wouldn't result in a material misstatement of the financial statements, but could be really important to the operations of the organization. You know, affect its ability to do what it should do on a day-to-day basis.
There are two things that we need to know. One is the question of how large is this relative to the total problem itself, and the second is whether or not the methodology used is totally wrong.
Well, the methodology that we use is a very scientific type of process that we use to select the items that we test. And we test items that we intend to rely on as part of our audit. So if we're not going to rely on them, we don't necessarily test them. We also look at the design of items or the system of internal accounting control. So there could be items that involve either design or compliance with the rules. Most of these items that appear in this report relate to compliance, particularly the IT comments. Now, year to year, we always find a few people that have been terminated and their access to the system isn't turned off. And we have a few people that's not complying with changing their passwords. And you would say those isolated individually aren't all that significant. What I did say to you before was it seems to us, and as time passes, the picture gets a little clearer, but there seems to be a number of circumstances where we see, while it's different people each year and different circumstances each year, where people aren't complying with the rules around data security and password security, that those things tend to repeat themselves, and therefore it may be worthy for the MTA to look at those collected and see if there's something they could do to alleviate that concern overall. But we wouldn't consider them, a significant issue. They could get to be significant, but, based on what we're seeing today, aren't.
And I have that in my audit plan to do exactly what David said to do, to look at those comments and say, why are they open? How can we close them out?
I would imagine that there's a certain level of breakage that's probably virtually inevitable
Right.
in an enterprise of this size.
Although if we find them every time, we seem to find them every time, which may be an indication it's a little bit more than just that.
Mm-hmm.
But it's nothing that we're really concerned about. And certainly when we find those items, they are fixed. Those items are fixed. But it seems to me there may be a little process issue somewhere that could be improved to alleviate some of those.
I mean, you had one point on MTA bus and inventory,
Yes, sir.
and I guess I know there were a bunch of issues relating to the integration of the private bus companies into MTA bus,
Yes, sir.
and I'm sure that inventory was not an easy
It wasn't.
integration process. I mean, how much of this is still trying to clamber out of that situation?
Virtually none. I mean, there's a little of the hangover from that you're right, is inherent within this. But we're really pleased. I mean, most of those issues that we had real concerns about have been dealt with.
Other questions? Do we accept the management letter? So we need to accept the management letter? Can I have a motion to do that? Second? Any objection? Done. Do I have a motion to adjourn?
Yes.
Second? Objection? Done. Thank you.